If you're under 30, do not buy a house right now. That's the message circulating all over social media. According to this viral post, a chain reaction has already begun. The United States is at war with Iran. The Strait of Hormuz is disrupted. Oil is surging. Inflation will come back. Central banks will raise interest rates. Mortgage rates will jump to 7% to 8%. People won't be able to afford their homes. Forced sellers will flood the market, and housing prices could fall 20, 30, maybe even 50%. The post ends with a dramatic conclusion. Sit on your cash. The biggest buying opportunity of your lifetime is coming. Now, when I read something like this, I don't immediately dismiss it because sometimes big economic events really do trigger large shifts. But here is the real question. Is this actually the sequence that's about to unfold? Or is this another example of how fear spreads faster than facts? Today, I want to slow down and walk through the real economic mechanics behind what's happening, and more importantly, what it could mean for real estate in Canada and the GTA. Because buying or selling a home isn't a tweet. It's one of the biggest financial decisions people make. So let's walk through this step by step. First, let's talk about the oil situation. Right now, the global conversation is focused on the Strait of Hormuz. This narrow waterway is one of the most important energy corridors in the world. Roughly 20% of global oil supply moves through that passage. So when there is a geopolitical tension in that region, energy markets react quickly. Oil prices have already started climbing, and when oil rises, the ripple effects are felt everywhere. Gas prices rise, transportation costs increase, shipping cost increases, manufacturing cost increase, and yes, even construction materials can become more expensive. So the first part of the viral post is actually grounded in reality. Energy shocks do push inflation higher. But here is the nuance that often gets missed. Not every oil spike becomes a long-term inflation problem. Sometimes they are short-lived reactions to uncertainty. Markets panic first and then they stabilize once supply routes reopen or diplomacy kicks in. So the key question becomes, is this a temporary shock or a sustained disruption? Because those two scenarios lead to very different outcomes for housing. Let's move to the second claim, inflation returning. The viral post suggests inflation will surge again and central banks will be forced to raise interest rates. But central banks don't react to headlines. They react to sustained inflation data. If oil spikes briefly for a few weeks, central banks often look through that volatility. However, if higher energy prices start pushing up the cost of goods, transportation, and wages across the economy for months, then inflation expectations can rise. And that's when central banks become cautious. So yes, higher oil can delay rate cuts, but it does not automatically mean rate hikes are coming. The Bank of Canada will be watching one key question. Is inflation becoming sticky again, or is this simply a temporary shock? The distinction matters enormously. Now let's talk about mortgage rates. Another claim in the viral post is that mortgage rates could jump to 7 or 8%. But here is something many people don't realize. Mortgage rates don't move only because central banks move. In Canada, fixed mortgage rates are heavily influenced by bond markets. Bond markets react to expectations about growth, inflation, and global risk. Ironically, in periods of major global uncertainty, investors often buy government bonds as a safe haven. And when that happens, bond yields can actually fall, which can bring fixed mortgage rates down. So the question is not always as straightforward as people assume. And the relationship also is complicated. And this is why predicting mortgage rates based on single headline rarely works. Now let's examine the most dramatic claim in the post. The idea that a surge in mortgage rates will suddenly create millions of forced sellers. This is where the comparison to 2008 usually appears. But the Canadian housing market today is very different from the system that existed before the financial crisis. Back then, lending standards in many parts of the world were extremely loose. People were qualifying for mortgages they realistically could not sustain. Today in Canada, we have something called the mortgage stress test. Buyers must qualify at a rate 2% higher than actual mortgage rate. This means most homeowners already have built-in buffers. So for forced selling to become widespread, you usually need three conditions happening at the same time. First, higher borrowing cost. Second, rising unemployment. Third, a surge in housing inventory. Without job losses, most homeowners continue making their payments even when rates rise. Housing crises tend to be employment crises first. So what would an actual housing downturn scenario look like? Let's walk through three realistic possibilities. Scenario 1. Short-term geopolitical shock. If the disruption in the Middle East resolves relatively quickly, oil prices may stabilize, inflation pressure fades, central banks stay cautious but continue monitoring the data. Housing markets remain soft, but they do not collapse. Buyers remain selective, sellers remain patient. This is actually the most common outcome historically. Markets panic first, then normalize. Scenario 2. Prolonged energy disruption. If tensions last several months and oil continues climbing, inflation could remain elevated. Central banks may delay rate cuts. Mortgage rates could stay higher for longer. In this environment, housing demand slows further. Buyers take more time and negotiations become sharper. But even here, price declines tend to be gradual, but not catastrophic. Real estate markets adjust slowly because housing supply cannot instantly expand. Scenario 3. Global recession. This is the only scenario where the viral crash narrative becomes plausible. If a prolonged geopolitical conflict triggers a global economic slowdown, stock markets decline significantly. Companies begin cutting jobs, consumer confidence falls, and households facing job loss may be forced to sell. That combination can push housing supply higher while demand weakens. And that is when prices can fall meaningfully. But notice something important. The trigger there is not oil. The trigger is unemployment. Housing downturns follow job losses far more often than they follow energy shocks. So what does this mean for buyers under 30? The viral post says, if you're under 30, don't buy a home right now. But age alone is not the right metric. The real question is different. How stable is your income? How long do you plan to live in the property? Do you have emergency reserves? Can you comfortably handle interest rate fluctuations? Buying a home is not about predicting the next headline. It's about whether your personal financial foundation is strong enough to hold the asset through cycles. Real estate has always moved in cycles, but most homeowners are not trading their houses like stocks. They are living in them for 5, 10, 15 years. And over those longer time horizons, the short-term noise often fades. The bigger lesson here, economic headlines are powerful. They spread quickly, and sometimes they create narratives that feel convincing because they follow a neat sequence of events. But real economics are far more complex than a 12-step viral thread. The smarter approach is not panic. The smarter approach is preparation. Understand the risks, understand the scenarios, and structure your decisions so that you can handle multiple outcomes. Because the goal is not to predict every twist in the market. The goal is to make decisions that still make sense, even if the market surprises you. In closing, a housing crash coming because of oil prices and geopolitical tension? It is possible that we see more volatility in the months ahead. But housing crashes don't happen because of one headline. They happen when several economic forces align at the same time. And right now, many of those conditions simply are not present, which is why the smartest move is not reacting emotionally to a viral post. It is understanding the data, understanding the risks, and making a plan that fits your own financial situation. And if you're thinking about buying, selling, or upsizing in the GTA, the most valuable thing you can do right now is understand how these economic forces actually affect your specific decision. Because real estate isn't about the market, it's about your strategy inside that market.